One of the most important changes in money usually does not arrive with a bell ringing. It arrives as a quiet shift in incentives. It arrives when one country changes how it settles trade. It arrives when one central bank changes what it holds in reserve. It arrives when an old machine that everybody assumes will keep working begins to lose one gear at a time. That is what I believe is happening now with the dollar, oil, and gold. One of America's strongest allies has stepped away from the organization that helped manage the global oil system for decades. At the same time, that same part of the world is talking more openly about selling oil in currencies other than the United States dollar. This is not a theory from the edge of the internet. It is being discussed in serious financial circles because the structure that supported the dollar for roughly half a century is no longer as automatic as it once was. When a system has worked for a long time, most people stop seeing the system. They only see the outcomes. They see the dollar being used everywhere. They see America being able to borrow more than other countries. They see oil traded globally. They see central banks holding reserves, but they do not ask the deeper question. Why did that system work? What held it together? And what happens if the incentives holding it together begin to change? That is the question I want to walk through, because if you understand this system, you will not only understand why gold has been acting the way it has been acting, you will also understand why many investors are looking in the wrong place for the next great change in wealth. I have spent much of my life studying systems. Markets are systems, currencies are systems, empires are systems, debt cycles are systems. And when you study systems long enough, you learn that the most important thing is not the headline. The headline is usually late. The most important thing is the cause and effect chain underneath the headline. The headline says an oil producer is leaving OPEC. The deeper story is that oil producers want more flexibility. The headline says China is buying less United States debt. The deeper story is that countries are reducing concentration risk. The headline says central banks are buying gold. The deeper story is that the world is trying to hold reserves that cannot be frozen, printed, sanctioned, or controlled by another power. That is the part most people miss. So let me begin where the machine began. To understand what is changing now, you have to understand the petrodollar, not the cartoon version, not the conspiracy version, but the actual mechanism after the oil shock of the 1970s. The United States had a serious problem. Oil was not just another commodity. Oil was the blood running through the industrial economy. It moved goods, it powered factories, it heated homes, it fueled militaries. When oil supply was threatened, the American economy did not just become uncomfortable, it became vulnerable. The United States needed a durable arrangement with the oil-producing world, especially Saudi Arabia and the Gulf states. The structure that emerged was simple in concept but enormously powerful in consequence. Oil would be priced and settled largely in dollars. Oil exporters would receive dollars. Those dollars would then be recycled back into the United States financial system, often through purchases of United States Treasury securities. In return, the United States would provide military protection, weapons, political support, and access to the deepest and most liquid financial system in the world. That was the machine. Oil created demand for dollars. Dollar demand allowed the United States to borrow cheaply. Cheap borrowing allowed the United States to run deficits that other countries could not run. Those deficits supported American consumption, military power, financial dominance, and asset markets. And because every country needed energy, every country needed dollars, this is what economists call an exorbitant privilege. I do not use that phrase lightly. It is a very real advantage. When your currency is the currency the world needs to buy the most important commodity on earth. You can do things that others cannot do. You can borrow more, you can import more, you can run larger deficits, you can finance military commitments around the world. You can have a deeper bond market because foreign governments and institutions need a place to store all the dollars they receive. That does not mean the system is free. Nothing is free in economics. It means the costs are hidden, spread out, and delayed. For a long time, this arrangement was stable because the incentives were aligned. The oil producers wanted protection and reliable buyers. The United States wanted global demand for dollars. The rest of the world wanted oil and access to a currency that could settle trade. But systems do not remain stable forever. They remain stable as long as the incentives remain stable. When incentives change, the system changes, and now the incentives are changing. The first crack is the desire for freedom among oil producers. For decades, OPEC functioned as one of the most important coordinating bodies in the world energy market. It was never perfect. No cartel is perfect. Each member always has its own interests, but it helped create a framework for production, pricing pressure, and political leverage. When a major oil producer wants to expand production, but the organization tells it to restrain output, tension appears. If that country has spent large sums building capacity and wants to sell more oil, then being told to produce less is no longer an advantage. It becomes a constraint. That is why the decision by an important Gulf producer to step away from OPEC matters. It is not just about membership in an organization, it is about the desire to set its own course. When a country wants to produce 5 million barrels and the system tells it to produce 3, the country eventually asks a simple question: why should I accept a limit that benefits the old arrangement more than it benefits me? That is how systems begin to loosen. Not all at once, not with a revolution, with a rational actor changing behavior because the old rule no longer fits the new incentive. The second crack is the rise of non-dollar trade. China is one of the largest buyers of oil in the world. If you are an oil producer and your largest customer is China, you will listen when China asks for more trade in its own currency. That does not mean you abandon the dollar overnight. It means you begin experimenting, you sign long-term contracts, you settle small portions of trade in another currency, you test new payment systems, you create optionality. That word matters, optionality. Countries are not necessarily trying to destroy the dollar tomorrow. That is not how smart geopolitical actors behave. What they are doing is reducing their dependence on one system that can be used against them. Russia learned that lesson directly when its foreign reserves were frozen after the invasion of Ukraine. Whatever one thinks morally or politically about that event, from a reserve management perspective, it changed the way every central bank in the world thinks. If your reserves are held in dollars or euros inside Western financial institutions, those reserves are not merely assets. They are claims inside a political system, and claims inside a political system can be frozen. That realization is one of the most important macro events of the last decade. It taught every country outside the core Western alliance that reserves are not just about yield, they are about control. A dollar bond may pay interest, but it also has a counterparty. A bank deposit may be liquid, but it also depends on access. A foreign reserve account may look safe, but it can be politically vulnerable. Gold is different. Gold has no issuer. Gold has no board of directors. Gold has no central bank that can print more of it by decision. Gold has no promise attached to it. It is not someone else's liability. That is why gold becomes more important in a world where trust between great powers declines. The third crack is the recycling of oil dollars into United States debt. This is the part that many retail investors do not understand because they think the petrodollar is only about pricing oil in dollars. That is only the first half of the story. The second half is what happens to those dollars after the oil is sold. For decades, oil exporters received dollars and then recycled many of them into United States financial assets, especially treasuries. That helped keep demand for American debt strong. It helped keep yields lower than they otherwise might have been. It helped finance the American state if oil exporters and major trading countries slowly reduced their need to hold dollars. Then the second half of that machine weakens. Again, this does not mean the United States dollar collapses. I do not believe serious analysis should be built around dramatic one. Day collapse stories. Reserve systems change slowly because the current reserve system is deeply embedded. The dollar is still used widely in trade finance, debt issuance, and global payments. The United States still has the deepest capital markets in the world. The United States still has the largest military, the strongest technology ecosystem, and the most important risk asset market. But the question is not whether the dollar disappears. The question is whether the dollar monopoly weakens. Those are very different questions. A monopoly does not have to disappear for its owners to lose power. It only has to become less complete. If countries settle some oil trade in yuan, rupees, dirhams, or other currencies, that reduces marginal demand for dollars. If central banks diversify reserves into gold, that reduces marginal demand for treasuries. If payment systems are built outside the Western-controlled network, That reduces marginal dependence on the current system. Each of these changes might look small by itself. Together, they form a pattern. And in investing, patterns matter more than isolated headlines. When I look at the world today, I see a movement away from concentration and toward diversification. I see it in central bank behavior. I see it in the way trade agreements are being discussed. I see it in the way countries are building alternative payment rails. I see it in the way gold has been accumulated. This is not emotional. It is not ideological. It is risk management. If you are a country and all of your reserves can be frozen by another country, you have a concentration risk. If all of your critical trade is settled in one foreign currency, you have a concentration risk. If your energy exports depend on an institution that limits your production, you have a concentration risk. And when the world becomes more fragmented, rational actors reduce concentration risk. That is why the gold story is not simply a story about fear. It is a story about portfolio construction at the sovereign level. Central banks are not buying gold because they watched a doom video on the internet. They are buying gold because they are looking at the world and saying, what can we hold that is not another country's liability? That is a very different type of question. A normal investor asks, what will go up next month? A serious allocator asks, what will survive across regimes? Gold answers a different question than a stock, a bond, or a bank deposit. Gold does not grow earnings. Gold does not pay a dividend. Gold does not innovate. Gold does not build a factory. But gold does something else. It sits outside the credit system. In some periods, that is not very useful. In other periods, it becomes extremely useful. When confidence in paper claims is high, gold can look boring. When confidence in paper claims declines, gold becomes a form of monetary insurance. That is why you have to understand the regime. In a regime of globalization, trust, low inflation, stable alliances, and expanding trade, financial assets tend to dominate. In a regime of fragmentation, sanctions, debt growth, inflation risk, and reserve diversification, scarce non-sovereign assets become more attractive. I am not saying one should put all wealth into gold. Concentration is rarely a good principle. I am saying that the case for gold changes when the structure of the world changes. The reason gold has responded strongly is not just because people are scared. Fear can move markets for a while, but structural flows move them for longer. When central banks buy gold year after year, that is not a short-term trade. When countries diversify reserves after seeing another country's reserves frozen, that is not a temporary headline. When oil exporters discuss non-dollar settlement, that is not just noise. Those are signs of a deeper adjustment. The easiest way to think about gold in this environment is through three forces: de-dollarization, debasement, diversification. De-dollarization means countries are looking for ways to reduce the dollar's role at the margin, not eliminate it completely, reduce it. That distinction matters because many people make the mistake of arguing against a straw man. They say the dollar is not going away and therefore nothing matters. But reserve systems do not need to end for investment implications to appear. Marginal change is enough. If the world needs slightly fewer dollars, that affects demand. If central banks want slightly fewer treasuries and slightly more gold, that affects flows. If oil trade becomes slightly more multipolar, that affects the old petrodollar recycling machine. Small changes in a large system can have big consequences over time. Debasement is the second force. The United States has been running very large fiscal deficits. Debt keeps rising, interest expense keeps rising, political appetite for discipline remains low. When a government issues more claims than the real economy can comfortably support, there are only a few paths. It can tax more, it can cut spending, it can default, or it can reduce the real value of money over time. Historically, governments with reserve currencies prefer the last option. They do not call it debasement, they call it policy. They do not say they are reducing the purchasing power of the currency. They say they are supporting growth, stabilizing markets, or ensuring liquidity, but the effect is the same. More claims are created. The currency buys less over time. People who hold cash or low-yielding fixed claims lose purchasing power. People who hold scarce real assets often do better. Gold cannot be printed by a central bank. That does not make it perfect. No asset is perfect. But it makes gold different in a world where paper claims are multiplying. Diversification is the third force. A world that is becoming more fragmented needs assets that are not dependent on one government, one payment system, one banking network, or one political alliance. Europe is rearming. The Middle East is unstable. China and the United States are competing across trade, technology, finance, and military influence. Emerging powers want more room to maneuver. In that kind of world, holding all reserves in the dollar system can feel efficient in calm times and dangerous in conflict. So central banks diversify. Investors should at least understand why. For a regular investor, the question is not, can I replicate a central bank? You cannot. The question is, what does the behavior of the biggest and most informed institutions tell me about the environment? If central banks are buying gold aggressively, they are not doing it for entertainment. They are responding to a changed risk structure. That does not mean you copy them blindly. It means you study the cause. Now, there are different ways investors think about positioning. Some people buy physical gold that gives them direct ownership but creates storage, insurance, and security questions. Some people use gold ETFs that is easier and more liquid, but it introduces a financial structure between the investor and the metal. Some people buy gold miners. Those can be more leveraged to the price of gold because when the gold price rises, a miner's margins can expand quickly. But miners also carry operating risk, political risk, cost inflation risk, management risk, and balance sheet risk. The metal and the miner are not the same investment. This is one of the most important points in commodity investing. A commodity can rise while a poorly run producer disappoints. A producer can rise faster than the commodity if the business is well positioned and the cycle turns in its favor. So the investor must be clear. Are you buying monetary insurance? Are you buying operating leverage? Are you buying a tactical trade? Or are you building long-term diversification? The answer determines the vehicle. In my own way of thinking, the most important mistake is not choosing the wrong gold vehicle. The most important mistake is failing to understand why gold is moving. If you think gold is just moving because of fear, you will sell too quickly. If you think gold is going to replace the dollar overnight, you will become too extreme. If you understand that gold is responding to dollarization, debasement, and diversification, you can size it with more balance. That is what good investing is. It is not emotion, it is not ideology, it is not drama. It is matching the asset to the environment. The same principle applies to the dollar. The dollar is not going to zero. The dollar is not finished. The United States is not suddenly irrelevant. That kind of thinking is usually more useful for getting attention than for building a portfolio. The real point is more subtle and more important. The dollar's unchallenged monopoly is fading. A monopoly can fade slowly and still change everything. If America's cost of capital rises over time because fewer foreign institutions recycle trade surpluses into treasuries, that matters. If foreign central banks prefer gold over additional dollar reserves, that matters. If oil exporters settle more trade in non-dollar currencies, that matters. If the United States continues to run large deficits while the world's willingness to absorb them changes at the margin, that matters. Markets often move before the full story becomes obvious. That is why serious investors do not wait for the headline that says the old system is over. By then, the prices have already moved. They watch flows, they watch reserves, they watch currencies, they watch policy, they watch who is buying and who is selling. And they ask the most important question in investing: what is the money doing? Not what are people saying, what is the money doing? In this case, the money is telling us something. Some of the largest institutions on earth are moving more wealth into gold. Some countries are experimenting with oil trade outside the dollar. Some central banks are reducing the concentration of their reserves. Some payment systems are being built to avoid dependence on Western financial pipes. That is a pattern. You do not need to panic about it. You do not need to bet your life on it. But you do need to understand it, because when the monetary system changes, the people who understand the change early often have a major advantage over those who only react after the change has become obvious. This has happened many times in history. Reserve currencies do not last forever. Dominant empires do not last forever. Trade routes do not remain fixed forever. The assets that protect wealth in one era are not always the assets that protect wealth In the next, the Dutch had their system, the British had theirs, the Americans built theirs after the Second World War and reinforced it after the oil shock. Each system looked permanent until it did not. That does not mean collapse is immediate. It means every system has a life cycle. In the early part of a cycle, the system is productive, it creates order, it builds trust, it channels capital efficiently. In the later part of a cycle, debts rise, conflicts grow, the benefits become uneven, and other countries begin looking for alternatives. That is the stage that matters when a reserve system is young and trusted. People compete to enter it. When a reserve system becomes politicized and overused, people begin searching for exits. That is why freezing Russia's reserves mattered so much. It showed the power of the dollar system, but it also showed the risk of being inside it. Power used openly changes the behavior of everyone watching. A sanction can punish one country and educate many others. The education was simple. If you are on the wrong side of the Western political system, your dollar reserves may not be completely yours. Again, this is not a moral argument, it is a cause and effect argument. And when you understand cause and effect, you begin to see why gold has become attractive to countries that do not want their reserves to depend on someone else's permission. For the United States, this creates a long-term problem. The United States has grown used to a world in which foreign demand for its debt is deep and persistent. That demand allowed large deficits to be financed more easily. But if the world diversifies at the margin, the United States must either offer higher returns to attract buyers or rely more heavily on domestic institutions and central bank support. Higher returns mean higher interest costs. More central bank support means more debasement risk. Either path has consequences. This is why the dollar, gold, deficits, oil, and geopolitics cannot be separated. They are part of one machine. Oil priced in dollars created dollar demand supported treasury demand supported American deficits supported American power protected the oil system. That loop reinforced itself for decades. Now, parts of that loop are weakening. If oil trade becomes more flexible, dollar demand weakens at the margin. If reserve managers diversify, treasury demand weakens at the margin. If deficits continue, debasement pressure rises. If geopolitical conflict increases, gold demand rises. That is the loop. Now, a good investor has to see loops. Most people see events. A serious investor sees feedback systems. And this feedback system points toward a world in which gold commodities, hard assets, and carefully selected real economy exposures deserve more attention than they received during the easy money globalization era. That does not mean abandon equities. That does not mean abandon America. That does not mean hoard coins in a basement and wait for civilization to end. It means stop assuming that the last 50 years are a permanent law of nature. They were not. They were the product of a specific monetary arrangement, a specific geopolitical arrangement, and a specific energy arrangement. Those arrangements are shifting. When arrangements shift, portfolios should be reviewed. This is where many people make a mistake. They think the only choices are doing nothing or doing something extreme. That is not how I think. I think in probabilities. I think in balance. I think in scenarios. If the dollar remains dominant, high-quality American assets still matter. If inflation stays elevated and deficits remain large, scarce assets matter. If central banks keep diversifying reserves, gold matters. If oil trade becomes more multipolar, energy and commodity systems matter. If the world fragments further, assets without counterparty risk matter. You build a portfolio that can survive more than one possible future. That is the principle, not prediction, preparation. The dollar may remain the main reserve currency for many years, but it may be less dominant. Gold may rise, but it will be volatile. Miners may offer leverage, but they carry business risk. Foreign currencies may gain share, but they have their own weaknesses. The point is not certainty. The point is recognizing that the old certainty is gone. That is why I think regular investors need to learn how to follow institutional behavior rather than react to media narratives. The media tells you what already happened. Flows tell you what serious money is preparing for. When central banks buy gold, that is a flow. When countries reduce treasury holdings, that is a flow. When oil contracts are discussed outside the dollar, That is a flow. When miners lag the metal and then begin to improve, that can become a signal when gold breaks through a long resistance zone and holds strength. Despite temporary selling, that tells you the demand may be broader than retail fear. These are the things that matter. And the most important lesson is that macro changes do not help you if you only understand them intellectually. They help you if you connect them to a process. The process is simple in concept. Understand the system. Identify the cracks. Watch where the money moves. Then decide how to position in a way that fits your own risk, time horizon, and principles. That is how I would approach this situation. The system is the petrodollar. The cracks are oil producers seeking freedom, non-dollar trade gaining credibility, and reserve managers diversifying away from concentrated dollar risk. The money is moving into gold and in some cases into assets connected to real scarcity. The question is not whether this is exciting. The question is whether it is structurally important. I believe it is. The United States built an enormous advantage from the dollar's position in the oil system. That advantage will not disappear in one morning. But if it erodes slowly year after year, it will change the investment environment in ways many people are not prepared for. Savers will notice it as inflation. Bondholders will notice it as real returns that disappoint. Consumers will notice it as a dollar that buys less. Governments will notice it as higher funding pressure. Investors who understand the shift may notice it as an opportunity, not because they are hoping for crisis, but because they understand that every structural change produces winners and losers. The old petrodollar machine made certain people and institutions very rich. A more fragmented reserve system will also create winners and losers. The key is to avoid being on the wrong side simply because you assumed yesterday's arrangement would last forever. That is one of the greatest mistakes in markets. People mistake a long-lasting system for a permanent system. They are not the same. A long-lasting system can be very powerful, but it is still conditional. It depends on trust. It depends on incentives. It depends on military power. It depends on trade relationships. It depends on fiscal discipline. It depends on other countries believing the benefits of using the system are greater than the risks of depending on it. When that calculation changes, the system changes slowly at first, then more visibly, then suddenly it looks obvious to everyone. By the time it looks obvious to everyone, the easiest money is usually gone. That is why I pay attention when the biggest players on earth start acting differently. Not talking differently, acting differently. Central banks are buying gold. Oil producers are seeking flexibility. China is reducing treasury exposure. Alternative payment systems are being developed. Countries are thinking about sanctions risk as a reserve management problem. Those are actions, and actions tell us much more than speeches. So if you remember nothing else, remember this. The dollar does not need to collapse for the investment regime to change. Oil does not need to stop trading in dollars for the petrodollar machine to weaken. Gold does not need to replace treasuries for gold to become more important. The system does not need to break for the opportunity to appear. It only needs to shift, and the shift is already visible. The practical takeaway is not panic, it is awareness. Do not build your financial life on the assumption that cash is neutral. Cash is a currency position. Do not assume that bonds are always safe. Bonds are claims on future currency. Do not assume that the dollar's past dominance guarantees its future dominance. Dominance is earned and maintained. Do not assume that gold is only for extremists. Gold is a reserve asset held by central banks for a reason. Do not assume that the headline is the story. The story is the structure underneath. That is how I see this moment. The petrodollar system gave the United States an extraordinary advantage. That advantage is being questioned at the margin. The questioning is rational. The response from central banks has been rational. The movement in gold has been rational. And the investor who wants to survive and benefit from the next decade has to think in the same way, not emotionally, not politically, not with slogans, with principles, with history, with cause and effect. The world is moving away from a single dominant monetary center toward a more fragmented and multipolar system. That process will be uneven. It will reverse at times, it will create false signals, it will scare people, it will create rallies and sell-offs. But the direction of travel is important. When the world fragments, neutrality becomes valuable. When currencies are debased, scarcity becomes valuable. When reserves can be frozen, assets without counterparty risk become valuable. That is why gold knows something before many investors do. It is not predicting the end of America. It is pricing a world in which America is no longer the only financial center that matters. That is a very different world from the one many portfolios were built for. And if you understand that before it becomes common knowledge, you have an advantage. The goal is not to be dramatic. The goal is to be prepared, because in every major transition, those who understand the machine early do not need to guess every headline. They simply need to position themselves on the right side of the incentives. And right now, the incentives are changing.